recording. So we talked about revenues on Tuesday. So now we're going to talk about cost of sales. And in this class, we've been referring to it as the cost of goods sold, right? And then I told you guys in all of my infinite intelligence and wisdom that the cost of goods sold represents the cost of the goods that were sold. But if you see here, Apple doesn't call it cost of goods sold. And as you start to look around at a lot of different companies in their income statement, a lot of companies are no longer calling it cost of goods sold, they're calling it cost of sales. Now, why would Apple choose the word cost of sales versus cost of goods sold?
They're not selling just goods anymore.
They're not just selling goods anymore, right? As which is the case with a lot of companies. A lot of companies are now moving to not only selling the product, but really what they're trying to sell you is that subscription, that service that says we're going to continue to offer this service to you on a monthly basis. And obviously the benefit there is they're creating a recurring revenue stream. Okay? So when we talked about, we talked about cost of sales already when we were in chapter 6 and we were talking about inventory. Right? So as inventory is being sold, we're crediting our inventory, making that asset account go down, and we're debiting this cost of sales account, which is an expense account, which makes the expense account go up. And we talked about when you debit that cost of sales account, you have 4 different methods that you can choose from. Does anybody remember those 4 methods? Well, I know everyone does. Who would like to say what those 4 methods are? Okay, waiting patiently. Waiting patiently. Oh, I'm seeing something in the chat. I see LIFO. I see FIFO. That's 2. I see average cost. That's 3. And there is a 4th one. Thank you. Thank you. Thank you. Specific ID, right? So those are the 4 different methods that we can choose from. Now, take this guess, put it in the chat or scream it out. What method do you think Apple uses?
FIFO.
FIFO. How do you know that?
Because you said one time in class.
Oh, you were actually paying attention? Oh, I didn't know students paid attention. But, oh, good. Yeah. Apple uses the FIFO method, first in, first out method. Went too fast there. So remember with FIFO, right, and we're using that example with the used markers. The FIFO, the first products that you purchase are the first ones that you sell. I think I compared it to going to the grocery store and buying milk, right? The first milk that the grocery store purchases is the first ones they want to sell, right? They have that conveyor belt, like getting things out. LIFO, where the last items that were purchased are the first ones sold, last in, first out. With LIFO, I think the example I used there was the hardware store, and you're buying nails, right? And they just have this bucket or box of nails or screws. And at the end of every day or every other day, they go in and they just pour more nails or screws into the bucket. And then you and I come along and pick up the 5 screws or 20 screws that we need and walk away. So there's some screws that have probably been there for 6 months, 8 months, right? They just keep going down and up and down and up, right? That's the LIFO method. We also talk about the average method. The average method is when you say, I'm taking the cost of everything that I purchased and just coming up with an average price for everything. Okay? So I'm not being mindful of any specific purchase or bundle of purchases that I made. I'm just going to take all the purchases, create a weighted average, not just a normal average or simple average, but a weighted average, which means kind of think about your GPA. Your GPA is a weighted average. A four-unit course, an A in a 4-unit course is going to count more towards your GPA than a in a 1-unit course, right? Because it's weighted more. So the more you purchase of inventory at a certain price, that's going to make your weighted average either go up or down depending on the price that you purchased it at compared to others. And then the fourth one was specific ID, which will not be on the test. So no need to really go into that a whole lot of detail, but specific ID is when you have a very unique product and you're saying, I manufactured this specific product, these specific specifications, and so I want to keep track of the cost of that product when it's sold.
Is that how like an electronics store or like a retail store would probably do it?
No, a retail store would probably be using FIFO. Or, yeah, probably FIFO. So let me make this distinction. So when you go to Target, right, Target is going to have FIFO for its Crest toothpaste, right? And it's going to be keeping track of what Crest product, when did we buy this product and when did we sell it for, right? And then they're also going to be keeping track of their Colgate toothpaste. They're going to be keeping track of their Listerine mouthwash. They're going to be keeping track of their, what's their brand? Up and Up. Their Up and Up list. So each product is being, they're keeping record of it separately. But within each product, they have to say, are we going to use the FIFO, LIFO, or the average method, which I think is another one that retailers could use. They could use the average method. What questions do you have about FIFO, LIFO, weighted average?
Will we be tested on knowing like what the incentive for a company to use a different one will be, or just how to use it?
I don't know what's going to be on the final, but I don't think there'll be questions on the incentive. There could be questions on which one is more advantageous given this particular situation, which gets back to well, how do you do it? You have to know how to do it so that you can figure out which one's going to produce the higher or lower expense. Other questions? All right, well, then why don't we do an exercise? So remember, we're talking about the Star Wars toy store, and that's Princess Leia picking up her Kylo Ren mask.
My favorite.
By the way, Kylo Ren is Princess Leia's son. If you didn't know that, it's not a spoiler alert. That's just shame on you. Really, shame on you. All right. So AT-AT. When I think back to my favorite Christmas gift I ever got, it was this AT-AT that I got from my dad. Anyway, no time for that. Here's the question. The Star Wars toy store started in December with an inventory of 9 AT-ATs that cost a total of $1,350. By the way, the AT-ATs are, well, it's right there from The Empire Strikes Back when you're on the planet Hoth. the Secret Rebel base. Anyway, during December, the Star Wars toy store purchased 27 AT-AT for $4,320. At the end of the month, the Star Wars toy store had 8 AT-ATs on hand. The store manager needs to select an inventory costing method, and he's asking you to tell him the cost of goods sold under these 3 different accounting methods. Average cost, FIFO, LIFO. So what would cost of goods sold be under each one of these scenarios? So I'm going to put you all into breakout rooms so that you all can learn together. I encourage you to take a picture of what you see there, so that when you get to your breakout rooms, you have it. And when you have the answer, or if you have a question, you can invite me into the room. And one other thing, what I have found to be very helpful in other classes is once you get in these breakout rooms, instead of like everyone just like turning off their videos and working independently and saying, what'd you get, it's probably helpful to do a share screen and let one person kind of share their screen and you all kind of work through it together. All right, rooms are open and you are free to rock and roll.